When it comes to investing, retirement, taxes, healthcare, and estate planning, the decisions you make today can greatly affect the quality of life for you and your loved ones tomorrow. What you need is straight and unbiased information on the most important issues you'll face when planning for your retirement and financial future. Good news, you found Premier Retirement Radio with Jeff Fogan. Jeff is the founder of Premier Retirement Planning and Wealth Management, and he's been guiding people financially and into retirement for 30 years. So get ready for an hour of the most comprehensive financial information on the radio. Premier Retirement with Jeff Fogan. And now here's Jeff Fogan and Jeff Shade.
Thank you so much. Welcome to Premier Retirement with Jeff Fogan, the radio show that gives you the straight talk and honest answers you need to help you reach your wealth management and retirement goals through smart investing and careful planning. My name's Jeff Shade, and I'm always just here to ask the questions, but you know the answers come from Jeff Fogan, founder and president of Premier Retirement Planning and Wealth Management. Hey, Jeff, how you doing this Saturday morning?
Doing great as always. Always fun to get up and talk to people in our area and hang out with you.
Yeah, there's a lot to talk about on today's show, Jeff. Of course, the election day is but a few days away. We'll talk about that a little bit, but on today's show, we're going to be talking about how annuities are impacted by interest rate cuts. Of course, we've got questions, case of the week, and we'll talk about investing for income. But before we get to all that, Jeff, this is interesting. I read that the Washington Post and LA Times are not endorsing a presidential candidate for the first time in years. Why is that?
I think it's because they think they don't have a chance. Their candidates so half-baked and unprepared and unqualified, and I think they realize that most of the American people, in spite of what the polls, which I think are rigged and made up anyway, say, that I think they just don't want to be that far on the bad decision. They'd rather just say, oh, I'll just have a no vote this year. I also think it might be because, back in the Obama days, they changed the rules as far as how newspapers have to report. There used to be some sort of a standard that there had to be some truth to what they reported, even though everything was spun anyway. And I think the reason that they got rid of the law is because they could never really enforce it anyway. But basically, there's no standard for reporting. It could be opinion, it could be lies, it could be propaganda, it could be whatever it wants to. And that's what the media has become over the last decade or so. And maybe they're afraid that Trump might put the kibosh on that and make them go back to some standard where they actually have to have a source and a reason and a fact that backs the stories that they do, or otherwise they can be sued for libel and other things that they haven't been able to be held responsible for. So there could be a lot of reasons for that. I think it's more likely that they don't want to be on the side of the loser, and I think they're worried about that. And I think the polls are showing that Trump's gaining momentum, and typically the Republican candidates, polls do show weakness going into the election even when they win. So I think the fact that Trump's strengthening is a good sign for the election. Now let's see if the Democrats, allow a peaceful transition of power. I think they'll probably try to do everything they can to stop that. They might even say we can't let an insurrectionist in the White House, so we're going to do everything we can to unratify the vote. The separation and how volatile the emotions and the tactics that these people are using in politics anymore, it doesn't surprise me anymore, but it's just getting out of control and ridiculous. So who knows? I do think that the market is trying to be healthy, not because it is being manipulated quite substantially. And we can talk about that kind of as we go through the show today on a few points. But we're not seeing a true picture of the stock market. I've said that for a long time. The Fed's given free passes to the banks to not report their bad loans. They actually shore their financial situations up and let them buy their own stock and not report losses. So it looks like the banks are doing great. It looks like the economy's doing great because the banks are doing great. And because the stock market's going up, somehow the economy's doing well. But it isn't. I've talked about that several times. So it is being a little bit manipulated. But I think that the hope that if Trump wins, that he can actually fix the economic underpinnings of what does support the market, that we could, in fact, have a softer landing than the hard landing that, history shows that we should still end up going through when just can't hold it up any longer. And eventually that'll happen. The rubber band always snaps. It always gets stretched. The market always does what it's supposed to. It just never does it when it's supposed, or when we think it will. It does it when it does it. And I think there's still a lot of market corrections ahead. Back to your question as far as why they would not want to endorse a candidate, I think there's just a lot of overwhelming evidence that she's not holding too well and probably won't fare too well in the election. And if she does, I think it's going to raise a lot of questions as to how badly rigged some of the voting processes are. I'm not a conspiracy theorist. I just know that statistically, things that happened in the last election can't happen mathematically and in the real world, and they did. I think now, just because people have seen the true colors of the party in power, there's a lot more people leaving that party and coming over in spite of whether or not they like Trump to put him in power. And I think the newspapers are a little bit maybe not scared of Trump, but, want to try to not be as mean and nasty as the opposing party is and try to somehow, I guess, inch their way to more neutral ground so they don't appear to be the enemy when Trump wins. I think that's probably more the case.
Jeff, even though we don't know who's going to be president for a couple of days here, it appears that the market has already priced in a Trump victory.
Well, it's also priced in a bunch of manipulation for a Harris victory, trying to prop the market up, as we've seen. I mean, the White House buys futures in the mornings when the market should plummet and there's weakness and bad earnings. But I think there's also a lot of people that are willing to buy into it because, hopes that Trump, who is more of an economic professional, he understands business economics and spending less than you make and, doing things that are fiscally responsible, not irresponsible, like printing money, price fixing, raising taxes. Those are all negative, and those are things that the other party wants to do, even though they say they're not going to. I mean, they've already shown that that's their agenda. So, I think the market is happy and thinks that maybe Trump can build those things that will create better earnings for companies, which we haven't seen in years. We haven't seen growth in earnings. We haven't, except for a few companies that are just kind of the newcomers in certain industries around cybersecurity and AI, for example, or there's a few good players in those industries. But most everything is flat, barely inching along. Even the big tech companies, the Magnificent Seven, other than NVIDIA, really aren't making robust gains, aren't really growing the way they could in a good economy. And I think the market or the investor who, because of so much liquidity, does have money to invest, is willing to take a bet on Trump fixing those conditions that have resulted in lacking earnings to actually create an economic boom for those companies and for Americans to where, maybe eventually the economy or the economic support for a market that's so overpriced right now might be more justified. So, I mean, there is no justification, in my opinion, for where the market is other than mass manipulation and BS. History shows that it just really is unrealistic to be where we're at as far as, what we're willing to pay for a price of stock for a dollar's worth of earnings, other than the fact that there's been a ton of liquidity printed, money printed, quantitative easing, even backdoor quantitative easing, while, they're BS in America. The Fed's saying there's rate cuts, and, we noticed that anything longer than about a 3-month bond is going up in interest, and the bonds are crashing. So that's counterintuitive. Not only counterintuitive, it's exactly the opposite of what they say is happening. So the hope is that the market will find some range or some level of, I guess, predictability and support from real economic factors that make sense for the market to be overpriced. I still think regardless of who wins, and I think even if Trump wins, I think there still needs to be some corrective measures taken. The market will still, gradually get back to some sort of a realistic value. The other thing is the banks who've been, coddled for the last couple of years that still need to pay back all these bank loans that the Fed gave them to support deposits because they weren't collecting money on all the bad loans from during the COVID phase. And still commercial real estate loans are in default to the tune of trillions of dollars. Yet the Fed doesn't make them own up to all the propping up that they've given. The Bank Term Funding Program that started 2 years ago, almost 2 years ago, still hasn't been paid back. And if they turn that corner and say, hey, you know what, banks, you're going to have to pay them back, I mean, that could start a big sell-off because the banks have to raise money. Banks have to come clean. We'll see that they don't really make as much money as they say they do in their annual reports. They're the only industry that can do that, by the way. But I still think in spite of this hope that Trump's going to just fix everything and it's going to go back, I think there's a little naivete in this whole idea that Trump's going to fix the market. I think he'll fix a lot that's wrong with the economy. I think he'll make it an easier recovery than it would be, but I still think there's going to be a correction. There still has to be some sort of a recessionary period where we reset to more realistic values. That's my opinion. Yeah, I could be wrong, but the bottom line is, we've got financial strategies that will thrive either way. So if I'm wrong, we still make money. If I'm right, we don't lose money, we still make money. So, if we just take a more sensible approach, look at this situation, look at what the odds are, against us, taking a lot of risk and making a lot of money going forward. I mean, they just are. So, let's not put all our eggs in that basket. Let's diversify and be smart, protect our principal, make money if it keeps surprising us and going up, but let's not lose money if the market, somehow gets to a black swan event, heaven forbid, World War III breaks out or some new inside job happens in America, like the World Trade Center bombing. I mean, how many illegal criminals have we allowed to come across the border that are probably setting up all kinds of inside terrorist activities? I mean, who knows? That kind of event like 9/11 would shut the market down for a few weeks and open 30-40% lower perhaps. I mean, you never know what could happen. The fact is the world's in a volatile place. It's really uncertain. Market's overvalued. And, if there is a sell-off or if there is some sort of a black swan event, whether it be, a terrorist type of a situation, a war type situation, the government calls all the loans that they've made to banks to prop them up. Or if China, heaven forbid, tries to cash in, the trillions of dollars that they have in government bonds. I mean, shoot, that's a way to manipulate our currency and make us look pretty poor in the world scene. And any of those events, could be pretty catastrophic to the markets if you've got everything out there at risk. So, I take the approach of you've worked hard for everything. Let's protect it. Let's be glad that the market's reacting positively to a Trump win. I hope it happens because I think Trump is better for the nation, even though he might not be the nicest guy in the world. You might not like him. Yeah, I don't know that I want to be his friend. He's kind of a little rough around the edges guy, but I want him between me and my enemy, and I want him between me and the economic burdens that the other parties put upon me and my family for the last 4 years. So he's my vote, and I hope he wins, and I hope he ends up being able to transition into the office and help make whatever landing we're going to have in this economic recovery period softer rather than harder. And I think if it goes the other way, it's going to be a lot harder than we can even imagine.
We're talking with Jeff Hogan of Premier Retirement Planning and Wealth Management here in Tucson. We've been talking about current events and the market pricing in a Trump victory. And again, if you've got questions about anything we've talked about, you'd like to get in and sit down with Jeff, talk about your own individual situation, how the market and the economy may affect your journey towards a confident retirement, call us here at Premier Retirement and ask for your no-cost, no-obligation Premier Retirement Roadmap. Not going to cost you a dime. 520-780-9059 is our telephone number. Make that call this weekend. Leave your name and number. Shelley will call you back during the week and set up that appointment for you. Again, no cost, no obligation, no judgment, 520-780-9059. You can also find out more about us online at premret.com. Earlier in the conversation here, Jeff, you were talking about one of the goals at Premier Retirement is to keep our investors' money safe. One of the ways we can do that is annuities. People equate annuities with safety, but annuities are impacted by interest rate cuts.
Well, interest rates do affect annuities. And by the way, before I get into the details, there's a lot of annuities, and there's some that I would generally avoid. In fact, drastically avoid. I don't even have a license to sell variable annuities because I think they're a ripoff. Have too many layers of fees. They're just as risky as mutual funds and cost 4 times as much. So it's ridiculous why, other than the fact that they allow a broker dealer to double dip, get a front commission and ongoing trails. In our business, we feel like you either get a commission or you get a trail. You get one or the other, but you don't get the double dip. That's the philosophy of our company. But for example, there's times when you might want just a fixed rate annuity for 4 or 5 years because you just want to make some interest until you need the money. So you can get a 4 or 5 year annuity. We call that a multi-year guaranteed annuity. That's fixed annuity. Fixed is safe, variable is risky. Anything that says variable, I wouldn't buy. Sometimes there's these variable hedged annuities that for an extra fee, they'll buffer your losses to where the most you could lose is 30%. Well, I don't want to lose any percent on an annuity. An annuity is really an account that you set up to pay you income for the rest of your life. So, if the insurance company can make more interest, currently than they could 5 years ago, for example, this multi-year guaranteed annuity, a 5-year annuity, they might be able to pay you 5 or 6 because they can make a little bit more than that if they reinvest your money right now over those next 5 years in the bond market. 3, 4, 5 years ago, they could invest at 1 or 2%. So you couldn't make that kind of interest. So right now, with interest rates being high, it's a great time to buy maybe a fixed annuity. 5 years ago, it might have been a good time to buy an annuity because 2% sounded like a lot better than 0% on a bank account or 1% in a CD. So, just because you bought an annuity a while back and it didn't pay as well as they pay now, doesn't mean you made a bad decision. It might mean you need to make an upgrade. And I'll talk about that based on the interest rate question you just asked. So interest rates are up right now. The Fed says they lowered interest rates, but in fact, if you look at the bond market has gone down, meaning the yields have actually gone up. Anything that's 2 years, 10 years, 30 years, all those long-term bonds have all gone up substantially, meaning the bond prices have gone down substantially. We're still losing money in bonds, which means interest rates are actually going up. Why? Well, because inflation is still a factor. The Fed says out of their one side of their mouth that they're lowering interest rates, and all they do is lower the short-term interest rate 0.5%. And somehow the market gets all happy and buys into the market. Yet interest rates are still going up, which is really a negative to the market, which means it's going to cut into earnings. And there's really no reason for the market to go up. The market should be going down. Well, why would we do an annuity? Well, it's more predictable. It's more stable. Fixed means safe. You can get a guaranteed rate of return. Or let's say if you're a Raytheon client, I have a lot of those that come in and they're going to start their pension in 5 years, but they've got a little nest egg and they want to live on a little supplement income because they're either going to part-time or They want to somehow hedge a few years. They can do what's called a single premium immediate annuity, where you basically get an internal rate of return of 4 or 5%, and you basically get your money back plus interest. So you have a nice little income while you wait for something else to mature or to grow. Now, my favorite kind of an annuity, and this also is impacted by interest rates, is a fixed indexed annuity. Now, maybe you've heard the commercials, on TV. It's like, what if there was an investment where if the market goes up, you get a big piece of it, and if the market goes down, you don't lose money? Well, doesn't sound like that the perfect investment. Why aren't there mutual funds that do that? Well, because mutual funds are built with just a bunch of stocks, and the stocks go up and down, and they really can't reduce the risk. But what an insurance company does is they take your money, they invest it in bonds, and they use the interest they make on those bonds, and they invest in the indexes in the markets. So they basically buy options on the market. So if the market goes up, your interest might double or triple. So if 3 years ago, the insurance company's making 2% on your money and they could triple that and give you 6%, well, you think that's pretty good. Well, what's the downside? Well, if the markets don't behave, then you get 0. Well, if you're only going to make 2 in the first place, what's a big deal? You're going to lose 2, but you're going to make 6 in the good years. And there's usually 6 or 7 or 8 good years in a decade and only a couple of bad years. Now, we've seen a lot more volatility lately. And so, maybe those numbers have changed a little bit for some people. But over time, over an entire decade, that's about the ratio that you'll see. So what about now? Insurance companies are making 5% on your money all day long, right? I mean, shoot, the 10-year treasuries, which is the most conservative, lowest rate interest paying, is still over 4%. And, insurance companies buy on economies of scale. They can usually get little better deals and enhance their interest. Plus, they use investment grade corporate bonds with big companies that never default and are really, highly secure bonds. So they invest your money in something that they're guaranteed to get a return on, or all but guaranteed to get a return on. I can use the word guarantee, by the way, with these instruments, legally and ethically. So they are guaranteed, and they're supported by, surplus of funds, by reserves, by insurance, by all kinds of levels of protection, even better, in my opinion, than a CD at a bank with FDIC insurance, which, by the way, is broke. Bottom line is, if insurance companies can make 5% of your money right now and they can double or triple it, let's say your upside is now 15% in a good year. And what's your downside? 0. Well, now's a great time to either try to convert some of these old annuities that, don't look as good as they did 5 years ago to new annuities. Maybe you take a 8 or 9% penalty, but what if your maximum you could make on an annuity 3 or 4 years ago was 6% or 0? And so you're averaging, let's just say 4 for discussion purposes. And let's say now you can make 15 on the upside and, 0 on the downside, and maybe average 9. Well, let's say your penalty is 6% to get out. It only takes 1 good year to make up the difference. It takes, an average rate of return over 10 years. You're going to make multiples. So some people are so worried about taking a penalty of 5, 6, or 7, maybe even 10% on an annuity buyout with the chance that they can make tons more. I think it's, you got to kind of weigh that. So I love annuities. They do react based on interest. I've kind of got a little bit, longer winded on this subject because it is a passion of mine. I like indexed annuities going into the type of markets that we're in. First of all, if the market plummets, we don't lose money. We lock in every year, every 2 years, every 3 years, depending on the strategy that you choose. But there's lock-in periods where that becomes your new principal every time you earn money. If you don't earn money, you don't go backwards. You're never going to spend less than you make. And it's a great asset preservation tool. It's also, because insurance companies are not risking your principal, they're able to give you more income. And if they can invest your money at 5% today, instead of at 2% like a couple of years ago, they can guarantee you higher retirement income. So you can do your own pension planning with an insurance company. Why not? They have safe money. They have more money than they owe. Unlike the stock market, which, is really subject to whatever the price of the market is, whether it's subject to black swan events, it's subject to stupid government maneuvers, it's subject to foreign countries, it's manipulating the currencies, it's subject to a lot of things economically that still leave wide open downside for someone who's retiring and wants to protect their assets. Not a good idea, in my opinion. So insurance companies can ensure that downside, give a reasonable rate of return. And the higher interest rate environment that we're in right now is such a great blessing, in my opinion, to take advantage of taking some of those profits off the table that we've made in the market, unbeknownst to me why. I mean, we've done pretty well, more so than I would have projected or believed. But here's the deal. All the index annuities that we've had from before are making money, and the new ones are making a lot more money. Why not go into this next decade where there might be a reset and not lose money while the markets are resetting, but make money when the market rebounds? Because we don't know what years that's going to be, and create a situation where there's more income. Here's the answer to your actual question. You said, what happens when they lower interest rates? Well, we're going to go back to the old days where interest rates are lower and you're going to make less on those annuities. So I have not seen in about 20 years a better time to either upgrade an annuity that you have before that you might not be super impressed with, even take some of those CDs off the table that you might be making 4 or 5% on right now. But what if they lower interest rates? CDs are going to go down too. You're not going to get 5 or 6% very long. So either lock it in a long-term fixed annuity of 5, 6, 7, 10 years at 5% or better, or do an indexed annuity with some of that money that you can make gains on. And by the way, instead of just taking the interest off of the CD like most people do on their safe money, you can actually take up to 10% free withdrawal on most fixed annuities. Sometimes it's 7, sometimes it's even more. But on average, it's about 10% that's liquid at any time. You don't have to wait for maturities. You have some liquidity, but you can leave the bulk of your savings intact, making money in a safe manner. So to answer your question, how do our annuities affected by interest? If interest rates go up, companies can pay you more. If interest rates go down, well, they pay you less, but at least your principal is still protected. So are annuities going to still be good in the future? Absolutely. Are they better now than they were 2 years ago? Absolutely. Are they better now than they will be in the future? Well, it depends. If interest rates go up, they'll be better in the future. If interest rates go down, they'll not be so good in the future. So that's my answer of how annuities are affected by interest rates. But the bottom line is if you get a fixed annuity, you're not risking your principal and you're making more viable the idea of not running out of money during retirement a reality.
Jeff, every week we like to talk about a case of the week. What has been an example of a case that you have had this week where you've helped somebody out?
Well, I just mentioned annuity upgrades. It's actually been a pretty big deal. Also, we even have LIRP, life insurance retirement plan upgrades, where you have life insurance that's going to create income with higher caps and higher returns on investments that insurance companies can pay. Sometimes it's worth moving cash value from either life insurance or cash value from an annuity to something new. And I had a client that came in about 4 years ago and set up, a plan. It was approximately $1.5 million in total assets. They did get into a LIRP with about a third of that, so $100,000 times 5 years, and that's starting this year going to generate about $35,000 a year in tax-free income, which is a pretty nice little benefit to not pay taxes on, especially as the Trump tax cuts will probably go away unless he gets in office and decides to renew them. I kind of think he will. The other thing that they did was they put a $600,000 annuity together that had an income rider that guaranteed about $2,400 a month in income. And that was about as good as we could find, 4 or 5 years ago, because, the interest rates were, 1 or 2%. And the company said, well, we think we can make 4 or 5% on this. So we should be able to pay this, client out about, roughly 5% of what they put in this annuity for the rest of their lives, guaranteed, even if it doesn't actually perform it at 5. So, in doing their annual review a few months ago, we came up with, hey, you know what, this income's $2,400. Let's shop it and see what we can do. And came out that we took, even with a penalty of about 6 or 7%, I think it was 6 or 7. So they had to step back and took, roughly $35,000 or $40,000 in penalty dollars, but got into a new annuity that starts out at $3,100 a month. So they went from $2,400 a month, or about just shy of $30,000 a year, to a new annuity that pays $31,000 or almost $37,000 a year. So we gave them about an $8,000 per year income upgrade. And the only way that they would lose money if she gets hit by a bus, and the death benefit is a little bit less. But fortunately, we're able to a joint life annuity and get that higher amount. So the husband would get it too. So even if she did get hit by a bus, as long as either of them were alive for, 4 years, they more than break even, and for the rest of life. And by the way, they're in their 60s. So I think they've got some longevity ahead of them. But, they'll probably benefit by the tune of $100,000 or $200,000 in actual income during the rest of their retirement life. So we looked at all the assets that they have. Some were performing, reasonably well. Nothing's, we're not in NVIDIA, so we're not knocking the cover off the ball, making 30 or 40 or 50 or 100% on stocks, but we're not losing any money. We're making a nice steady 5%-ish, give or take, in our safe money accounts that are liquid. We're just kind of waiting for the market to reset while, and get this election behind us. Our indexed annuities have been doing, 8 to 10 or 12% on the upside during this, kind of surprisingly good time in the market. And we were able to get a higher rate of return from a new company and increase their income by $8,000 or $9,000. So, we're not one and done when we build the plan and park everybody's money. We do annual reviews. And when the annual reviews come up and we see that there's an upgrade opportunity that we can, make life better, then we try to do that. A lot of people come in, it's like, oh, I could have made more in a CD. Well, 4 years ago, you couldn't have made more than a CD. You could today, but you can also make more in a new annuity account. So let's just keep, chasing the money. I mean, if you like CDs at 2% because it was better than the 0% they gave you on a money market 5 years ago, and you upgraded to a 5% now because you can, well, do the same thing with all your other stuff. Don't complain about it. Just look for opportunities to upgrade. And, by and large, I'd say about 80% of the time, situations are upgradable in today's interest rate environment.
So, Jeff, before we continue our conversation, again, I want to talk to our listeners. If you have an annuity, you're not sure whether you're getting what you could out of your annuity, and you'd like someone to take a look at it, we would love to do that for you here at Premier Retirement. Again, no cost, no obligation. Come and talk to us about your annuity. See if we can upgrade that and get you more money. Our telephone number, 520-780-9059. Jeff, time for a break here on Premier Retirement. When we come back, we're going to answer listener questions and also talk about ways to invest for income when our show continues here on 790 KNST, Tucson's most stimulating talk.
You can't start a trip you've never taken without a plan, and you can't start your retirement journey without a comprehensive plan to get there safely. To request your no-cost Premier Retirement Roadmap, call 580-780-9059 or request it online at premret.com. Now back to more Premier Retirement with Jeff Hogan and Jeff Shea.
We so much appreciate you joining us here for Premier Retirement each and every week on 790 KNST. We're on the air for you 4 times a week on terrestrial radio, 7 a.m., 9 a.m., and 1 p.m. Also Sundays at 11 a.m. You can also hear our radio program by going to our podcast. That's right, we're a podcast. Each and every show that we do is converted into a podcast. You can find it by going to wherever you get your podcasts, searching for Premier Retirement with Jeff Hogan. You'll get this show and all of our past shows so you can stay on top of your journey towards a confident retirement. You can also Google Premier Retirement with Jeff Hogan. You'll find our podcast there. Okay, Jeff, time to dive into listener questions this week. Bill's listening to us in Tucson, and Bill says, although everyone has a different situation, at what tax bracket does it make sense to start converting your 401k into a Roth 401k and pay the taxes up front? For example, I'm 42 and my wife and I have a combined income of $560,000, putting us into the 35% federal tax bracket. We have $2.5 million in traditional 401k, 403b accounts. Assuming we both retire at 67, does it make sense to start converting into Roth accounts and take the tax hit in the next 5 to 10 years compared to 25 years from now?
It kind of depends. If you plan to be in that tax bracket, work another 20 years, you're probably going to have $10 or $15 million in assets, and you'll never not be in the highest tax bracket. So it may be worth doing if you think the highest tax bracket is going to go to 40%. If you think, you're at the highest earning level you're going to be at, you only plan to work another 5 years, maybe you have $3 or $4 million in there, then I would convert later after you're not making $560,000. So, try to convert when you are going to be in the lowest tax bracket possible, or, just, keep kicking the can down the road. And, depending on what your tax plan is, you might even use charitable remainder trust for IRA money. You can use charities to offset some taxes, and you could do even, generation skipping almost with payouts from charitable remainder trusts with IRA money. There's a lot of, tax planning you can do through more of an estate, long-term kind of an advanced estate planning level than you're probably considering, rather than just, the simple thing that a broker-dealer would tell you, oh, Roth or regular IRA, manage your portfolio, stocks, bonds, cash, that's all there is. Well, there isn't all there is. There's a lot more things. The other thing you might want to think about is, instead of doing a Roth conversion, just kind of let what you have in there grow to $5 or $10 million and use, only invest at your companies to whatever they match you on the 401k, and take another couple $100,000. I mean, I'm guessing most people I know that make $560,000 are probably saving half of that, well, a third of it's going to taxes, and maybe, another third of it, like maybe 150 or 200,000 even could go into savings or investments. Let's say you had 100,000 extra, you could put into a LIRP, life insurance retirement plan at your age. If you're healthy and young, you could do that for 10 years and end up getting, $90,000 to $100,000 a year tax-free income in retirement, which honestly, in my opinion, is way better than a Roth. It's a Roth on steroids. The reason being is you don't actually deplete the asset in the life insurance. You borrow against your future death benefit on a tax-free basis. On a Roth IRA, It is actually reported the IRS's income as provisional income, so it might affect taxes on other things like Social Security and whatever else they might want to surcharge for people they consider are rich. And I think you're going to be in that category if they ever do what they call, asset balancing or, steal from the rich, give to the poor type thing. The government is such a benevolent entity to do that for us, is to use our money to help those that, didn't work hard and didn't get $560,000 a year income jobs, so we can pay their way. So I think the government's going to impose more and more of that entitlement program on them on the backs of people like you and me and people that, are, working hard and have invested in themselves and make good income. So there's a lot of people that think Roth is really the only opportunity, but our clients like LERPs because it's life insurance. It's kind of a stealth product. It's not even considered a retirement plan, even though it is, and it'll generate income. With a Roth, you take that money out. If it's in the stock market and the market's down and you take tax-free money out to live on, that money never grows again. In the LERP, life insurance version of the Roth, which I think is a Roth on steroids, you might want to consider, how that would work, generating income in the future. And when you take money from a LERP, you don't actually take money from a LERP. You just spend your future death benefit early. So it's truly life insurance, not death insurance. So for people that are in the higher tax brackets, like me, I put all the money I can, I put into LERPs. I don't even have a traditional, I have a very small number. It's not even seven figures, but in IRA type stuff that I'm going to have to pay taxes on later, it's very few of those dollars. I want to pay taxes now as I earn it and never pay tax again. Real estate's a decent hedge if you use it right. I don't really do advice on real estate. I do invest in that. I also invest in LERPs, life insurance retirement plans. You can also do some tax deferral where you don't pay the taxes on the growth, but you pay taxes later on just the growth portion of those assets and use it kind of like a pension plan where it will be partially taxed. Again, depending on how much of that $560 a year you're spending and how much you can put away, there might be some alternatives you want to look at instead of just continuing to load up that 401k. However, in your tax bracket, you might want to load up your 401k to the max just to get the write-off. And then if there's a period of time between the time you retire and the time you have to start taking those distributions out, that might be the time when you might be in a lower than 30% bracket to do those Roth conversions after you're not making 560. Maybe I don't know if you have a pension with that job. I'm guessing at that income, you're just, loading up your 401ks and you're kind of responsible for your own retirement plan. And if that's the case, you can build it yourself, or you can convert to a Roth during a lull period where you're not in that highest tax bracket, but would otherwise be later if you kick that can down the road. I don't want you to go from the 35% tax bracket down to zero for 10 years just to return back to the 45% tax bracket that we might have, or 50% tax bracket we might have 10, 15 years from now. So again, pay taxes on those assets at the lowest tax bracket you can. And it might take a little bit more long-term planning or to look at your plan, which is what we do here, is to decide if it makes sense to just start putting into the Roth in the first place. Maybe not doing Roth conversions, but just, do a Roth allocation in your 401k at work as it is, or do a LERP, or do an annuity type of a retirement plan with income that's partially taxable or, has some exemptions tax-wise. So a few opportunities for you. I'd love to look at your big picture to give you a better answer, but based on what you told me, that's probably the best I can do at this point.
Bill, thanks for listening to us in Tucson. Of course, give us a call here at Premier Retirement. Sit down with Jeff and talk about that. 520-780-9059. We'll also send you out here Jeff's book, Retirement, The Road Ahead. Okay, Jeff, Gary's and Sam Hughes got an interesting question here. Gary says, given the current state of world affairs, I am convinced that the U.S. will be drawn into World War III within the next few years, regardless of who wins the election. Assuming this premise is correct, what would be the best strategy to prepare for such circumstances financially? I believe this is a legitimate concern.
Well, Gary, I believe it's a legitimate concern too, especially with the weakness we've had in our own government and the fact that nobody's afraid to do anything because they know that they don't have anybody here in the U.S. to be scared of. I think Trump might give us a little bit buffer on that. But again, I think there's enough damage done already and enough people that are ticked off at each other around the world that war is not out of the question. I think it's a very big possibility. So I think you're right. Now, things that typically do well in wartime, given the fact that, the stock market might not do well. In fact, I think the stock market will probably get hit really hard. You might find that oil goes up. You might find sectors like aerospace goes up because of the, arms and stuff that are going to be used. Raytheon stock, for example, might be a great play. It's actually a decent play right now, just with what we're seeing already. Lockheed Martin's been doing well. So we might see sectors in the market that do very well in a situation where we go into a war. Gold, oil, commodities typically do well because they're a shortage and, they're scarce. And if you own some of those, then you might make a killing and do really well as far as financially during what would otherwise be bad times for the rest of the world. Interest rates might end up going up. I don't know that just because there's a war, there'll be limited ways to make money. I think there'll be plenty of ways. You just follow the smart money. One of the things that I really like about the strategy I talked about earlier in the show on the indexed annuities is that we have indexes that are indexes of indexes, and they automatically rotate to where the money flows. For example, if commodities are doing better than the S&P 500, they'll roll into commodities. If foreign stocks are doing better than U.S. stocks, they'll roll into those stocks. If interest rates are higher someplace else, meaning that they get a better return on investment on fixed income, they'll go there. If the interest rates are increasing, however, the price of those instruments go down. They wouldn't be in those at that point. If interest rates start going down, and if the Fed actually lowers interest rates on more than just the short-term interest, which is the day-to-day overnight lending rate, which is ridiculous. It doesn't show anything other than the fact that everybody wanted a rate decrease and they supposedly got one, but they really didn't. The fact is bonds are plummeting right now. Interest rates are going higher. It's not a good time to have longer-term bonds than 1 to 3 month bonds, in my opinion. So there's always a place to make money. The cool thing is the multi-asset risk category type indexes. And there's more and more of them coming into play. There's some made by, Goldman Sachs, or some that JP Morgan has. And historically, their rotation into different sectors has been very good. And it's algorithm based, and it's based on following the money. And, these big banks that run these indexes, they know where the money's going, and they can make changes. And that's why even on safe money, stuff that's safe as a CD. I just talked to somebody that's been in an annuity with one of these multi-asset indexes just last night on the phone before I left work. And they're up 19, just shy of 20% in about 15 months. I mean, that's pretty darn strong for something as safe as a CD because of the fact that it can rotate into the stock market if it's doing well. But if the stock market isn't doing well, it can roll into gold, precious metals, oil and gas, energy, utilities. It can roll into foreign stocks and different things like that. So I think, a combination of, maybe doing some hedges that typically do well in, hard times, like, some gold and silver. Doesn't ever hurt to have a little bit of that. Have a bunch of bullets and scotch too, as Harry Dent, an economist I used to love listening to, would say. He says, in a state of affairs that gets that bad, you want to be trading bullets and scotch. He says, everybody's going to want that. And maybe some food too. But, I don't know if gold and silver is going to be a tradable commodity. If our monetary system doesn't blow up with World War III, I think some of these indexes of indexes are a great play to not only protect your principal, because even in a war state, insurance companies still have to have the assets to support their liabilities that they owe you. The stock market does not. So again, it's just one more reason why it kind of underscores what I said before about keeping your money safe and still getting some upside. And the cool thing is that upside would rotate into those asset classes that have upside and out of those that don't.
Gary, that's a great question. Thank you for asking it. And thank you for listening to us. And Sam Hughes will send you out Jeff's book, Retirement, The Road Ahead. Next question, Jeff, is Roger listening to us in Savannah. And Roger writes, I'm going to be 54 this month. Unfortunately, I have cancer and I don't expect to make it to 55, let alone 56 or beyond. I have a 47-year-old wife and an 8-year-old child. My question assumes that I'll die within 2 years. They'll be 49 and 10, respectively, when it happens. When I was first diagnosed, we established an irrevocable trust with a well-structured, long, slow payout based on life milestones. The trust balance is $13,000. My child's 5 to 9 plan balance is $70,000. I'm struggling with a form of inheritance I should leave for my wife and child while wanting to be as tax efficient as possible, given that my wife will be in a much higher tax bracket at retirement if she does not remarry. In short, who should get the retirement accounts and who should get the life insurance?
Well, I don't have amounts on that retirement account and the life insurance. I think, with a number, we could tell what kind of a higher tax bracket that your wife would be in. My heart goes out to you. I'm so sorry about your diagnosis. My father was diagnosed almost the same age you did and passed away at 59. And it was a heartache for our family. But and unfortunately, there wasn't assets to leave behind. So at least you're in a position, it sounds like, that you have life insurance. And that's tax free. Now that can be reinvested into an income plan for later, or your wife could use that as supplemental income if she doesn't have enough income of her own to make ends meet at this point. I don't know what the situation is how much of the income that you're living on is hers and how much is yours. If she's going to be in a higher tax bracket when she retires, I'm guessing that she has pretty good income, or that you have a fairly substantial 401k or something that would move over to her benefit when you pass. And again, it would kind of depend on how much it is, what the longevity expectations of the family is. You've got a 529, it's going to continue to grow, 10 more years before your 8-year-old needs to use it for college. I don't know if you want to keep putting money into that. There's other ways you can do that. You could even use, some of the life insurance money or the balance in the trust and invest that, and, see if you can make that into extra money for, books and fun and stuff that isn't deductible or isn't appropriate for 529 money to go. So unfortunately, I have a question that has a little bit left to be open, but I think the big deal is, how much is in tax-free and how much is in taxable, and are you planning on growing it? Can we turn the future taxable income or IRA into an income plan where you can predict the income on a steady basis through retirement, which would also make your tax situation steady, and then use the life insurance for those miscellaneous expenses that you can pull from whenever you need a little extra money, and that wouldn't push you into a new tax bracket because, being a tax-free benefit, you could use that, for those what-if expenses down the road.
Roger, thanks for listening to us in Savannah. Again, our hearts and prayers go out to you and your family. We would love to sit down with you and help ease your mind a little bit if we could. 520-780-9059 is our telephone number. Make that call this weekend and set up that appointment with Jeff. We appreciate you listening to us. Anybody who does have a question, same story, call it into Shelley if you'd like, 520-780-9059. You can also go to our website, primret.com. Leave it in the contact page there if we use your question on the air. We'll send you out Jeff's book, Retirement, The Road Ahead. And again, that is the same number that you want to use if you want to come in and sit down and talk with Jeff and get your premier retirement roadmap at no cost and no obligation whatsoever. It's just a casual conversation. Don't bring your checkbook. We're not going to charge you anything for this. Complimentary, 520-780-9059. Make that call today. Okay, Jeff, we're going to start off on a path that we may want to continue next week, but we're not sure about this. It's 7 ways to invest for income. Of course, when you're working, you get a paycheck. You can expect that to go on. But when you retire, you've got to make your own paycheck. So we want to invest for income. So let's start off with the basics here. The first is cash deposits. Now, when I think of cash deposits, I think of safety, but I don't think much in terms of cash flow or growth. What can we do with cash deposits to help generate some income?
Well, I'll tell you one application that a couple of my clients are using. I'm not sure I'm crazy about it, but, it is the rules. And, I have a client that just retired at age 60 and doesn't really want to spend IRA money because it's taxable. They can basically live tax-free. He's got about $500,000 in cash in the bank. What his plan is to live on the cash deposits, make as much interest as he can. I think he's laddering some CDs. It's bank money, so I don't look after that portion of his assets. But he's living on cash that's already been taxed so that his tax bracket can be zero and he can get free health care through Obamacare and, basically any other handout from the government he can get for looking like he's poor, even though he's sold a business, he's got millions of dollars waiting to use later. But most of that is going to come out in a deferred note program. So some of that cash was from the sale, but some of it's deferred that will come out later. And so the taxes will be basically pushed down the road as deferred interest on this buyout note. The other thing that he has is a 7-figure IRA that he doesn't want to touch until he's on Social Security and already making income. Then he'll start using that other income to, match his roughly $100,000 a year lifestyle. But at that point, he'll be, paying a little bit for his Medicare Part Bs and, maybe some deductibles here and there, or maybe a supplement plan. But that's part of why you might use cash deposits to kind of fill a gap between, to kind of help you with a tax situation. Or, if it comes in part of your plan, you might be using cash deposits. Let's say you want to live on $120,000, but the tax bracket changes at $75,000. And part of that's going to be a tax deduction based on standard deduction. So you need an extra $20,000 a year, but you don't want to take it out of your IRA and be taxed at 25% on it or a higher tax bracket. Well, in that case, use cash to supplement. Or even better, and we'll talk about it later, is something that's not even on the list, is that is LIRP, life insurance loans, which is another income. So there should be 8 or 10 of these on this list of this article. But bottom line is the cash deposits can supplement or fill in gaps, and nothing wrong with that. It just depends if you have enough to cash to make a difference or not.
And Jeff, with cash deposits, I think of CDs. What are they paying these days?
Well, if you get a short-term one, they can push 5% still. The longer-term ones are actually going lower because everybody's expecting interest rates to go down. Honestly, I don't expect interest rates really to go down because the inflationary pressures of this fake quantitative tightening didn't really happen. This quantitative easing is still happening with all the favors that the Fed is giving the banks. And by the way, banks are shareholders. Basically, banks are partners with the Fed. Banks are who kind of supplies the Fed their money. When the Fed needs money, the banks loan the Fed money and the Fed pays them interest, supposedly. They can use that to make it look like they're making a ton of money. Problem is when the Feds do that, they squeeze out banks from making real loans. So bottom line is, the interest rates they're still doing quantitative easing through this bank, head fake program that they're using. So I think interest rates are going to continue to go up, not down. Even though, the idea is that they're going to, so long-term interest rates, you might get a 3-year CD at 3% rather than 5%. You might get a 1 year at 5 or a 90-day at 5, maybe a 1 year at 4. So I think the idea is interest rates should start ticking down. I just kind of am skeptical. I don't think they are.
Ways to generate income. We're talking about that subject with Jeff Hogan here at Premier Retirement. Let's talk about bonds a little bit, Jeff. How can we use bonds to generate income?
Well, I'd be skeptical about bonds, especially now that we've seen that when interest rates go up, bonds get hit really hard. If we still have inflationary pressures, like I just mentioned, we may see bonds continue to drop in value. So if you're planning on buying bonds to sell them, maybe not a good idea. Right now, short-term bonds are my favorite play because you can get around 5% and you can live off the interest. But you can also ladder bonds. You could actually set up a ladder of bonds to where no matter what happens, you get paid the interest that's on the coupon rate until maturity, and then you just cash them in at face value. In other words, at $1,000 per bond. And so if you ladder bonds, you could generate an income plan that would probably generate you somewhere between 3 and 5%, guaranteed rate of interest with very little risk. The only risk you would take is if interest rates go up, you're not going to be able to, you have that loss of potential, the opportunity cost of higher interest. And if you sold out, if you had to sell for an emergency, you'd basically force yourself into a loss situation where you'd have to cash in those bonds at a loss. So I wouldn't do a laddered bond program for all your money. I would do it, if you're going to do it at all, do it on a portion. My best play in bonds, honestly, is let the insurance company invest in bonds for me and take the interest and leverage that interest on indexes better than I can myself. So honestly, the annuities I talked about are actually a bond play because the insurance companies are using bonds. They're just making more interest on the bonds than I could make. And guess what? They're also taking on the risk of those bonds going up and down in value because they've already laddered bonds for years and years. They've got enough bonds that are coming to maturity that they don't have to take a loss. If you need some money, you don't necessarily have to lock in losses like an insurance company would, if they, bailed out of, 10% of their entire cash reserves.
Ways to generate income. We talked about cash. We talked about bonds. What about preferred stocks, Jeff? I don't know a lot about those other than they have sort of hybrid qualities that are associated with bonds and stocks, right?
They do, but keep in mind, preferred stocks, I had a person just recently that, about a few years ago came in and says, I make $50,000 a year in my preferred stocks. I got $500,000 in there and they're paying $50,000 a year. And I just want to keep them because, that's real solid. And I said, preferred stocks can change in value just due to default risk or just due to the fact that the company could lower the interest. So guess what happened? Last time he came in, he's making $20,000 a year on interest. And guess what? Those bonds aren't worth $5,000 anymore. They're only worth about $250,000 anymore. And they're paying an 8% dividend. So, the value of a preferred stock doesn't necessarily have to, it can fluctuate based on, what the market would pay. But preferred stocks, typically, they are preferred in the standpoint that they have, an interest rate guarantee. But, it also has a marketability value. If you want to sell those preferred stocks, they're not necessarily guaranteed. Now, there are some preferred stocks that, hold their value, but the kind of like a bond, but the bond interest can change. So there's a few variations of them. But, I guess the best thing is if a company ever had to liquidate, you're guaranteed your money back before a common stock. Common stock's kind of the most risky has got the best upside, but doesn't have any protection as far as guaranteed interest or dividends.
Jeff, hate to cut you off, but we're running short of time this week. We're talking about ways to invest for income. We talked about cash, bonds, preferred stocks, and dividend-paying stocks. We'll continue this conversation next week. 520-780-9059 is our telephone number. If you'd like to come in and sit down with Jeff, get your no-cost, no obligation, no judgment Premier Retirement Roadmap. Again, you can make that call right now, 520-780-9059. You can find out more about us online at premret.com, premret.com. Jeff, out of time for this week. Thank you so much for your time. It's been a really enjoyable visit with you, and I want to thank our listeners here in the greater Tucson area for joining us. For Jeff Bogan, I'm Jeff Shade. Have a great weekend. We'll talk again next week with another edition of Premier Retirement right here on 790 KNST, Tucson's most stimulating talk.
Investment advisory services provided through Premier Wealth Advisors, LLC, an Arizona state-registered investment advisor. Securities transactions are placed through TD Ameritrade. Insurance and annuity products are offered through Premier Advantage, Inc., DBA Premier Retirement Planning and Wealth Management. Investing involves risk, including the potential loss of principal. Any reference to protection, safety, or lifetime income generally refer to fixed insurance products. Insurance guarantees are backed by the financial strength and claims paying abilities of the insurance carrier. The show is intended for informational purposes only and is not to be construed as advice or recommendations. Due to show format, accuracy and completeness cannot be guaranteed. Premier Retirement and its representatives do not provide legal or tax advice and may only conduct business with residents of states and jurisdictions where they're properly registered.